What's up everyone, welcome back to another video with the Millennial Finance. Recently, some very strange things have been happening. Stocks have been showing signs of life, cryptos have moved more than 50% from their lows, and indexes are also rallying over 15%. Is this the start of a new bull market, or is this simply a dead cat bounce? Let's find out. Cha-ching! Before you start, if you're looking to start investing, then I would say this is one of the best opportunities that you would have in recent times. And if you want to have a look at some of your options, check out the links in the description below. You can sign up, you can get some good perks, and you support the channel as well. Also, as usual, this video is not financial advice. At the end of the day, you have to do your own research because it is your own money, so don't follow what I say blindly. So things have started to look rosy again. Bulls are starting to get hope built up, and I finally remembered that my investment portfolio can actually go up in price. I didn't remember that my portfolio could actually go green and earn money. What a life hack, right? But is this all just a bear market rally baiting us in just to crush our souls all over again? Before we even get there, what is a bear market rally? Basically, just like how stocks don't go up in a straight line, we know that it goes up, has a small retracement, and goes back up. When the stock market goes down, it doesn't go down in a straight line either. This is especially true for bear markets, where we usually see sharp short-term bounces that may look like the start of a new bull market even though we're still in an overall market decline. What happened in 2020 was an extremely rare occasion where stocks just went minus 30% all the way down without much big bounces and then go all the way back up after that. Even then, there were days that the stock market was up, 8-9% a day, which I guess you could consider a bear market rally. If we go back to the global financial crisis in 2008, we saw that stocks dropped nearly 50% over the span of a few years. In between this time span though, we had multiple bull rallies and some of them even went up by over 24%. Now, if we saw the market go up by 24%, not gonna lie, many people would think that a new bull is starting, including maybe even myself. But what this does is basically it traps bulls because, like I said, people think that a bear market is over, the bull market is starting, and then, people start buying more, only for it to drop even harder all over again. But how do we know if what we're going through is simply a bear market rally or truly the start of a new bull? We wouldn't want to miss out on a new bull, would we? Well, I'm sorry to disappoint you, but the short answer is no one can know what is the scenario right now. However, what we can do is look to history as a guide and have a look as well at the data points that have been released recently and how the markets reacted to it. So the first thing that we will be talking about is company earnings with a mega focus on big tech. Apple, Amazon, Meta, Alphabet, and Microsoft all reported their earnings last week. They may not be the powerhouses that they once were, but combined, all of these stocks contribute to 25% of the S&P 500, which means that yes, their earnings do matter to us and it will have a big impact on the stock market. Out of all of these companies, only Apple managed to beat expectations, while Meta was by far the worst performer. Interestingly enough, nearly all of the CEOs and CFOs who are on the earnings calls during the time speaking to analysts had very similar narratives. Basically, inflationary worries, a strong USD, and an uncertain economic future were the main things that they touched on. Despite not performing well in Q2 and giving weak guidance or completely no guidance at all of these companies except Meta saw big increases in their stock price after earnings. For example, Google's parent company Alphabet missed both earnings and revenue and gave weak guidance for year-over-year growth, but still saw their stock increase by over 7% after earnings. Well, there are two ways that we can look at this. Firstly, if the CEOs of these big, huge companies are giving us warning signs that the next few quarters may look bleak, then surely we must take that into consideration, right? Maybe they're all learning from history after giving overly bullish guidance in 2020 and 2021, only to see it all crumble in 2022. However, the fact that their stock prices went up after a poor earnings shows that analysts think that the future is maybe a bit brighter than what they paint it to be, or that the stocks have already discounted or priced in these next few quarters. Either of these scenarios would be actually good for the stock market because what it means is that there's not much room left to fall unless earnings somehow get worse than what it currently is at. On a similar note, the forward price to earning ratios of all companies in the S&P 500 has actually been its lowest since the market crash in 2020, which shows that valuations have already started to compress. Just to digress a bit, Meta's earnings actually looks very worrying. Earlier this year, they had the first user growth decline year over year in their entire history, and in Q2 of 2022, Meta had their first ever negative growth in revenue in the entire company's history. Like I said, they were by far the worst performers of these big tech companies, and their stock was the only one to drop after the earnings call. So I do have a small allocation of Facebook in my long-term stock portfolio. I'll have to go through the analyst deep dives and calls before I decide if I want to sell or hold on to my stocks. Anyway, the next thing we'll talk about is the topic of the year being inflation and interest rates. I've said this many times before, and it's no secret that inflation is soaring and it is a major problem. To address this, the Fed is basically forced to increase interest rates to cool down the economy by reducing demand. In the last FOMC meeting that was held on the 27th of July, the Fed decided to raise the interest rates by 75 BPS again, which usually is an extremely bearish sign for the stock market because that will impact demand heavily. This, coupled with the last interest rate raise of 75 BPS in June, means that over the last 2 months, the Fed has increased rates by 1.5%, which only happened the last time the Fed was fighting inflation in 1980s. In the FOMC meeting though, Powell did mention that instead of committing to a certain interest rate that they want to target for the end of the year, they will actually start looking at data points before deciding on what to do next. And yes, one of the biggest indicators on how they decide to take this forward will be inflation. Even though it still came out at record numbers last time around, many people, including myself, believe that this is the local top for inflation and there isn't much more room to grow. By the time this video comes out, the inflation data should come out soon, so let's see if I'm right or completely wrong. And again, the stock market rallied quite hard on the announcement of the 75 BPS raise, even though this is, like I said, extremely bearish for the economy, and people know that there will definitely be more rate hikes this year. This goes back to the same point that I was talking about earlier with regards to company earnings. The fact that the stock market is going up despite the announcement of negative news means that the stock market has already priced this in. This goes to show why you shouldn't trade based on the announcement of data, because you expect that something so negative would send the stock markets down, but everyone already anticipated this months ago, so the stock market actually rallied on it. However, if inflation somehow doesn't start going down like we all expect, or they maintain at a very high level, then I would expect that the Fed will have no other choice but to continue raising rates. This will 100% lead to a longer, drawn out and harder decline on all of our investments. The final thing that we'll touch on quickly is US GDP. The US just announced the Q2 GDP and it fell at an annualized rate of 0.9%, marking 2 consecutive quarters of GDP declines for the US. I'm not sure why this article states that the US GDP unexpectedly fell, because I'm pretty sure nearly all of us expected it. Anyway, this would normally be considered a recession because we have had that 2 consecutive quarters of negative GDP growth, even though US politicians right now are saying that we're not in a recession. To me, this doesn't really matter, because whether they declare a recession or not, we all know that US GDP is declining. This, of course, is partly due to the raise of interest rates, which led to lower demand. The more important question is though, how did stock markets react to this negative news? Again, stocks rose 1% despite the bad GDP data. This is mainly because many analysts think that if the economy starts getting too weak, then the Fed will have no choice but to stop raising interest rates so much. Some of them even think that it'll be so bad that Powell and team will actually pivot to QE all over again, which means they will have more liquidity and the bull market will definitely be back on. Just to give you guys an idea, in the 1980s, high inflation, asset prices were dropping like crazy over a few years, but as soon as the Fed pivoted and went back to QE, it recovered all of its losses over a span of a few years in just 4 months. So to sum it all up, this has been one of the most highly anticipated weeks in recent times. With 3 major events happening, nearly everyone had eyes on the data and how the stock market would react to it. So nearly every single data point was bearish, yet the stock market continued to rise. Some people may find this odd, but I have talked about this before. Markets are incredibly efficient in pricing in the future. It's not priced based on what's happening now, but it's priced based on what institutions think will happen in the next few quarters. For example, whatever is happening now, high inflation, high interest rates, low GDP, this was all priced in a few quarters ago, which is why the stock market decline started back then. In the past, stock markets also tended to bottom when economic data was at its worst. As people say, you know a top is coming when you see prices going down despite positive news, and you will know that a bottom is coming when you see prices going up on the back of negative news. Despite all of this, there's still no surefire way to know whether this is a bull market or a bear market rally. Basically, if everything goes as estimated, then I would say we're not going lower, especially for assets that have taken a big hit like growth stocks and crypto. However, we would never really know because like I said, these are all just estimates, and when the data eventually comes out, if it comes out worse than expected, then yes, things can get worse. Despite all of this, my personal opinion is that we are closer to the bottom than the top. I'm being very selective on the stocks, ETFs and cryptos that I decide to invest my money in right now because I don't think that an overall basket like the S&P 500 is ready to moon just yet. This is because S&P 500 has many industries like the oil and gas, commodities and all of this that helped prop it up all these months, and I think that these stocks still have further to fall. So, let's say half of the stocks in the S&P 500 is going up, half of them is going down. Net, it would roughly be break even. That's just an illustration, of course. It is not 50-50 like that, but for that reason, I'm not going to put more money into the S&P 500 yet. If you look at specific sectors though, like for example clean energy, you can clearly see that there are individual names that are really starting to moon and preparing for the next bull market. And these are the kind of assets that I want to start looking at and adding more into my portfolio. Also, I'm thinking of making a video about some of the top ETFs I'm looking to invest my money in right now, so let us know down in the comments below if you would be interested in that. As usual, if you have your normal DCA strategy, you should just continue with it, or if you actually decided to stop it previously for whatever reason, then now will be a pretty good time to resume it. So let us know. What are you doing with your investments right now? That's it for today's video, guys. Thanks for watching to the end. Give us a huge thumbs up and subscribe to the channel if you haven't already. If you want to start investing, have a look at some of the options. We'll leave the links down in the description below, and we hope that you find something that suits you. See you guys in the next one. Peace out.